Well, everyone, good afternoon and hello. Our attendees are all joining at this moment, and we're very excited to have you with us. We've got a great audience from all around the world today, so thank you for dialing in from various time zones. RedeConnect is our virtual conference series that we host annually with multiple thematic sessions all across our 6 global offices. For Rede Asia, it's our second virtual conference where we speak about Asia. I'm very, very glad to be joined by my esteemed panelists today, so let me introduce them. So firstly, we have Harry Marukami, who is CEO of IA Partners. Hello, Harry.
Good morning. Good afternoon, everybody. Nice to be here. Thank you.
Thank you, Harry. IA Partners is just on the cusp of their second fund, excitingly launching this year. Harry has an illustrious career in private equity, where he was previously investing at the Development Bank of Japan, DBJ.
Thank you.
Welcome, Harry. Next, we have Alex. Alex Lee is one of the most well-known private equity investors in the Asia region and one of the managing partners of Axiom. People would know Axiom. Hi, Alex. People would know Axiom for their 18-year history of investing across Asia in primaries, secondaries, and co-investment formats. Importantly for today's discussion, Alex is going to shed light on topics relating to Axiom's Opportunity Fund, which is a pan-Asia direct investing strategy targeting growth stage companies using a minority investment approach sourced mainly via secondary markets. Thank you, Alex.
Thanks for having me, Charles. Thank you.
We have Justin Ryan. Justin is co-founder and managing partner of Glow Capital. Hello, Justin. Glow is an Australian private equity firm investing in exceptional management teams and high-quality cash-generative businesses, scaling across Australia and New Zealand. Justin has what I would describe as a Hall of Fame track record, having helmed Quadrant's Growth Fund as managing partner and previously general partner of Catalyst. So, welcome, Justin. Last but not least, Yifei Wang is a partner at GL Capital. Hi, Yifei.
Hello, everyone. Many thanks for having me, Charles.
Pleasure. GL is a specialist investor in controlled private equity and mature healthcare businesses in China. And GL Capital is on to their 5th fund now and have been a sector leader in the field for some time. So welcome. We're looking forward to having a great discussion with you today. Before I dive into questions, as an opening comment, what we're seeing here at Rede is quite a strong uptick in investor interest in the APAC region. This is tracked by our Rede Liquidity Index, where we survey global LPs. And interest in Asia has grown from a low of 29 points in second half of 2024, just a year ago, on our RLI index to 45 points as of the end of last year. This represents a significant increase, obviously, so it gives us confidence to say that LP interest has returned to the Asia region. And unsurprisingly, developed markets such as Japan and Australia are very much in focus for 2026, while China excitingly has been more prominent on investor consideration. And lastly, it's important for investors to round out their Asia exposure with a pan-Asia kind of consideration, particularly in the growthy mid-market. So, we think our panelists are best positioned to give insights into these areas. So, without further ado, let's dive into the topic of thriving in Asia Pacific. Firstly, we're representing a large proportion of APAC regions of interest here. Interested to hear what you're most excited to invest in your region today, and could you give us some thoughts on the evolution of buyout and growth investing in your region? I'll start with Justin.
Thank you, Charles. Yes, Australia is has a very stable geopolitical environment and a long history of GDP growth, solid rule of law, And over the last 25 years, has been a consistent performer in private equity, both at the buyout level and the earlier stage parts of the market. So I think it has proven to be an attractive market to invest in, and we have an economy that is blessed with a strong resources sector and also well-managed migration. So whilst the growth of the economy is perhaps not as strong as in other countries, it's very consistent and is generally reasonably strong. So we think it's a good economy, educated workforce, and I'm very excited about the opportunities in the mid-market sector in particular. The buyout sector, as I say, has been good, but it seems to be more cyclical. But in the mid-market, we have generational succession issues. We have great founder stories and family businesses that are growing and are faced with that intergenerational succession issue, or young founders growing, and the products, Australian brands are well regarded globally. So I think it's a very attractive place to invest in. I'm very excited to be investing in.
Thanks, Justin. Turning to Harry, Japan's been a real hotbed of interest. How is the opportunity evolving? Harry, over to you.
Yes, thank you. I would say that Japan historically has generated reasonable return to investors. According to Bain Company, we see that making 3x MOIC between 2010 2024, 15 years time frame. So that's nice. But today we are seeing fundamental changes in the market, which is most exciting part of the story. One change is corporate reform and capital market reform. And we are seeing so many activists making noise today in the open capital market, and we are seeing even unsolicited tender offer by foreign companies against Japanese traditional manufacturing businesses. So this is putting pretty much pressure on every single publicly traded company. They are considering divesting non-core businesses or going private themselves, and that's creating a huge deal for private equity society. That's number one. Number two, we are hitting into inflationary economy as we speak. We went through 3 decades long of deflationary economy, where in manufacturing businesses you can never improve margin because you are always under pressure to be squeezing gross margin. Today, gross margin you can improve because their cost basis is up, so you need to increase price, and there you can reallocate resources into more profitable products. And we are seeing expansion of gross margin in traditional manufacturing businesses. And so there, we are shifting our value creation initiatives to adjust more into inflationary economy, which is a very interesting thing because in the Japanese manufacturing industry used to be having a low margin only, but under inflation economy, you can change the profile of profitability and also cash flow generation power. So that's my excitement. Thank you.
Thank you, Harry. That's definitely a dynamic shift, right? So it's interesting that Justin, you paint an exciting picture in the mid and lower mid market that continues in Australia, but in Japan there's clear dynamic shifts, Harry, that you've painted.
True. Yes.
Very exciting. Yifei, I'd like to turn to you because China has been so topical. How are investors warming up to China again today? How has that evolved on a buyout and kind of growth trajectory?
Cool. So we are a manager focusing healthcare. So what I'm going to talk about is more kind of focus on the healthcare sector in China in general. So we have been kind of going around and talk to our current and prospective investors and arguing that, from this moment in the next 2 to 3 years is really the golden age of investing in healthcare in China. And that's driven by a few factors, starting with the sheer market size of healthcare in China and the growth potential. So healthcare is a trillion-dollar industry in China and expected to grow double-digit year in, year out in the next 15 years. So kind of, like Harry was mentioning, the Japanese kind of story is almost what we stand in kind of Japanese in 1990s. It's almost like China today. So we have a huge wave of aging population to go through in the next 15 to 20 years. And that's the biggest and certain driver of healthcare volume growth in China. So that's kind of the sizable and growing market is what we see as a positive factor. And the second factor is really the global expansion potential. It used to be a very domestic focused market in China in healthcare. But now, with the capability of local companies, even small to mid-sized enterprises being able to offer cutting-edge innovation globally, they are not only looking at a sector in China, but also looking at exporting their IP, their licenses, and their technology to a global stage. And the global market is, about 10 times the size of Chinese market, almost as a second growth kind of driver for those businesses. And the third point is really about the macro environment. Charles, as you mentioned, Chinese has been investing in China PE has been quite controversial, last few years, right? Since we have seen the geopolitical tension here and there. But from that, while blessing in disguise is the transaction multiple, particularly in buyout, is highly attractive at this moment. The last two deals we did was, mid to high single-digit EBITDA multiple for business growing double-digit. You put it into a kind of leverage buyout, you get 20 to 30% IRR without even assuming multiple expansion or any luck in IPO. So that type of cash flow driven and kind of cash flow support the valuation what we are seeing today. So that's why we are positive on healthcare in China.
And Yifei, you're looking at mature cash flow driven businesses, right? In that valuation commentary.
Indeed. So we are looking at cash flow positive growing businesses in the small to mid market in healthcare in China.
It's very exciting because it's unbeknownst to many investors that I guess Chinese healthcare has really taken on the international stage and is one of the largest markets globally. Thank you, Fei. Alex, curious on your thought. You've got a 30,000-foot view across Asia, right? A pan-Asia view. But and also curious on your comments on the other geographies that are hot markets today, in particular India and Korea.
That's right, Charles. We do have a pan-Asia strategy, but let me comment a little bit on India and Korea. So firstly, with India, I think it's clearly a very attractive market for private equity today. It continues to benefit from several long-term tailwinds, including the favorable demographics, rapid digitalization, and sustained investments in public infrastructure. I think what's really changed in recent years is the maturity of the private equity ecosystem. There are more serial entrepreneurs, deeper management teams, stronger governance, and clearer exit pathways, particularly through trade sales as well as IPOs. And for Korea, I think it's also very exciting for us. There's a pretty healthy mix of venture growth and buyout opportunities here. It's giving. We are actually seeing a lot of world-class corporations, top-tier talent, and the public and private markets are both getting deeper. So there are many strong companies emerging from venture stage to growth stage, giving Axiom an opportunity to partner with our Korean GPs to support their growth into globally competitive businesses. And these companies eventually go public or become prime acquisition targets for global funds as well as trade buyers. So yeah, very exciting times.
Thank you, Alex. it's clear that Asia, us here as a group, we're seeing the upswing of things, and that's probably aligned with the investor interest uptick that we're also seeing. So thanks for painting that picture and overview. Let's turn to our next question, next topic, which is sourcing and winning over sellers. I'd love to explore market-specific ways that you're approaching sourcing, and I think we can kind of glean some insights on how each individual market is distinct. Alex, so just sticking with you, you've got a very unique sourcing methodology, particularly in the Opportunities Fund. How are you honing and leveraging Axiom's unique platform to do so? And how are you winning over sellers?
That's right. So we are celebrating our 20th year in the business as a firm this year. So today we manage over $9 billion, and we actually have partnered with more than 100 GPs, directly investing in over 150 companies and indirectly backing over 3,500 portfolio companies. So through these relationships that we've built with our GPs, with the portfolio companies, we're able to identify high-quality assets, which we can then get additional exposure to via the secondary market. So in terms of sourcing, our approach is largely driven by our long-standing relationships with GPs, as well as the portfolio companies who understand how we work and value our knowledge of the market. They know that we stay constructive throughout the investment life cycle, and hence they see us as a preferred partner to replace a shareholder who needs liquidity. So oftentimes they reach out and let us know if they know of a shareholder that for whatever reason, is seeking to liquidate, to exit their stake in the company. I think that speed is another key differentiator. So with our investment committee based in Asia, we can engage in diligence and come to a decision efficiently. So all of this helps us to source and win deals, especially in proprietary and time-sensitive situations.
Thanks, Alex. That's so true. It's fast-moving markets, and having very, very good visibility to judgment and being able to be on the ground, that's can be so helpful to winning deals. Justin, in Australia, seemingly a highly competitive market, how are you finding deals? How are you winning deals on the ground?
Yeah, Charles, I've been in the market a long time and started in the buyout end of the market, in fact, where it is very highly contested, and typically you would be buying a small, looking at a smaller number of assets that are usually sold via processes that are contested, and access to information is difficult. And I think for us in the mid-market, there's far less competition, and that allows, we have to sort through a larger number of opportunities, but in doing that work, we can find gold. For us, it's less about competing against other bidders in an auction process. It's more about convincing the founder to make the decision to take on a partner. Often the founder, we invest in businesses that are generating cash and usually have great margins and are very attractive businesses. So they don't actually need the money. They really they really are looking for the right sort of partner. And then I think where it's helpful is if you've been around a long time. And in my case, I've done 27 or so transactions and been in the market for almost 30 years, actually. So, and including a stint running a public company myself. So that sort of credibility, bringing to bear the list of the previous founders and sharing stories, previous investments, and offering those founders and CEOs as referees is a very powerful way to win business, because when people see what you've done previously with other assets, then they aspire to do the same. So we very much believe that being in that smaller end of the market is far more attractive from a sourcing perspective than being in the larger end of the market.
Thanks, Justin. It's all about building trust in your kind of long-term network, right? And success begets success as you continue, right? So that's very, very clear. Harry, I think Japan is a mysterious market to some. It's a wide SME market, right? In the mid and lower mid market. And so the competition is probably less from peers, but more in terms of convincing entrepreneurs to do a deal, and also the art of operating, within Japanese conglomerates to carve out deals, right? Where, as I understand, IA is active on both spectrums. So, what's the art of war there?
Well, I think first thing, you need to be different from other private equity firms, your competitors. You need to say that your strategy is pretty different in front of potential sellers and target companies. In our case, because of our track record from DBJ, our team started in DBJ back in 2009, and we carried the DBJ business up until 21, at which point we got independence. So we kind of carry that kind of legacy from DBJ, which is pretty important, because we are dealing mostly Japanese middle market manufacturing traditional industrial businesses, as opposed to other private equity firms mostly chasing consumer-related deals. So we are dealing with the corporate Japan people, which are very conservative and very naive. And that area particularly, name like DBJ, Development Bank of Japan, which is government-owned financial institution. And today our leading limited partner is JIC, Japan Investment Corporation, which is another government-related financial institution. So these names implies that we are kind of carrying semi-national flag of Japan. And that way to build trust and credibility in front of potential sellers and target companies, that's very important. But in addition to that, we heavily leverage our human connections that we built over DBJ days and Partner Fund One, because Japanese private equity, particularly in middle market, all about connections, human connections. So rather than jumping on potential deals that brought by brokers or investment bankers, we directly call on potential sellers, like conglomerates and family businesses and so on and so forth. Because as much as you leverage your human connections, you have a better chance to win the deal on exclusive basis. And we are kind of exclusivity freak. We always demand exclusivity, but for that, we need to leverage our human connections. Lastly, of course, we need to demonstrate our track record in manufacturing businesses. And we have a track record from DBJ days and so on and so forth. So by being strong in manufacturing business itself is a differentiation factor. And you need to talk about how you can add value to portfolio companies, particularly adjusting into inflationary economy, as I said. So, of course, you have to demonstrate track record and valuation initiatives, but the first two things, brand and human connections, very important.
Thank you, Harry. It's that's very insightful, because it means, as you mentioned, carrying a national flag, but that's about being domestic. That's about being, again, kind of on the ground, but and generating trust across your networks.
That's right. So we say that we are people who are invested by DBJ and JIC. That means that you're trusted by the government, which is important in front of traditional manufacturing people.
A unique position.
Yeah.
Ife, Jill has been a sector expert for so long, really built up such a strong position. So you do have that uniqueness, right? In the context of working with carve-outs in pharma, as one example, what are other sourcing edges, and how do you continue to keep up that edge?
Sure. So what we have seen in the past 3 to 5 years since kind of the breakout of COVID, actually, is that the market is really kind of, we see two significantly rising deal opportunities for our kind of increasing focus, which is the mid to mid-market buyout. And one kind of increase is China was never a buyout market because, entrepreneurs, when they found a business, they were young and it was a growing business and nobody's willing to sell. But as we come into this age, right? So the average entrepreneur or entrepreneur-owned businesses, these entrepreneur and the average age of those founders are now entering 60 to 65 years old. Age really is a very significant factor in the decision of whether to sell those businesses. And we look at public companies as a reference. So there's about 800 listed companies in China, and 40% of the founders are age 60 years and above, of which 15% are 70 years and above. So those kind of rising group of kind of entrepreneurs willing to consider selling their business as a option is a significant and rising opportunity for us. We look at 200 buyout transactions last year and did one. So that was kind of the ratio of opportunity to action we're looking at. And I agree with kind of the previous panelists, Justin and Harry both mentioned. So we look at proprietary transactions mainly. More than 90% of the deals are proprietary. We do not like to participate in an auction where we're price taker. We want to be a price setter. So that's one thing on one side. The other side, Charles, you mentioned carve out is another opportunity set we're seeing rising. But for us, it's actually much more difficult to transact. Some of our peers are much more willing to do that type of transactions. That are basically multinationals selling their operations in China altogether. We look at quite a few, and we did not do for the reason that we do not want to be a price taker. We do not want to because as a multinationals, when you are selling the business, inevitably you have to do wrong process. We do not want to be a part of a process where price is only winning factor. Well, if you deal with entrepreneurs, there's a lot more, how to take the business to the next level, how you keep the brand, how you incentivize the employees. There's a lot of other cards on the play for us to do.
Thanks, Yifei. That's very impressive. Gives a lot of color into how you work with companies. So just keeping with you on the next topic, right, is, as we move along the value chain, right, we're talking about sourcing at the, in the middle of your portfolio management. What are the operating levers that are most important to drive alpha as you're working with entrepreneurs, as you were talking about, right? What are styles of working with management to drive value creation?
So you talk about generating alpha, but I guess the first step we actually first go into an entrepreneur kind of owned or family owned business is actually to protecting the alpha, to professionalize the business. It's almost kind of the first step when we come into the business, right? Because those businesses are owned and operated by the founder for the last 15, 20, 25 years. So the founder, obviously, they are very successful businesses, cash flow generative and growing. But founders have their own biases here and there. So we try to kind of professionalize the organization, sales, procurement, compliance, etc. We try to protect and make sure the business is a well-oiled machine to operate on its own on an ongoing basis. That's the first step we do. And then the next kind of two things we try to create alpha, linking back to our thesis of a golden age of investing in healthcare in China, are two things. One is helping them to expand the market. Typically, that's overseas market for us. So these are Southeast Asia, other regions in Asia or even Europe into US. So those are the things where we as a fund have some resources to help them. As an entrepreneur, if you run a small to mid-sized business, you do not have that type of resources and connections to really open yourself up and chase the global opportunity. But we as a fund can help them. And the other side is on the innovation side. Really, innovation has been and will continue to be a significant driver of growth of those businesses. Really helping them to formulate an R&D strategy, investing in R&D dollars in where would can potentially generate most of the impact. So those are the things we typically do when we acquire business.
Thanks, Yifei. Justin, I'll turn to you as you're a proponent of organic growth in our discussions. Take us through how you create value.
Thanks, Charles. Well, look, actually, you've raises a good point about the protecting the earnings that you buy, but it is a challenge to do that and grow at the same time. So one of the issues is to make sure you've got a business with enough scale that you can put the talent in and the resources in and grow at the same time. It is a juggling act for us. Firstly, we've got to make sure there are multiple growth levers. So we don't really want to be beholden to one. In private equity, things don't always go in a straight line. Plan A doesn't always work according to plan. So you need to have a number of levers to pull. For us, when we look at the business in the first place, we've got to make sure that it does have a super growth outlook. It's got a big TAM. It's got a tremendous runway to grow, and we do a lot of research into that. We make sure there is that runway for growth, and then it's around executing that runway. More often than not, in product-based businesses, it is about taking the products offshore, setting up 3PLs and building the local brands overseas. We have quite a bit of experience on the digital marketing side. And so having had a strong track record in growing that style of business, that is often attractive to founders when partnering with us. NPD is also important. And I think, high quality businesses are able to launch new products, whether it be through R&D or otherwise, general innovation. So growth is everything really for us. Not, Charles, to say that we don't do the occasional bolt-on acquisition, but the sweetest growth of all is organic growth. So the trick is to try and find that business that is, for us, in that breakout growth stage. Not too much gearing, because you don't want a financial handbrake there. You really want to set the situation up so that you can run free and grow it quickly and build a sustainable, professionalized business. So that's very important to us, growth. And there are a number of levers that we can pull and do pull, and we always want to make sure there are a number of levers.
And Justin, how much inorganic growth do you do on the acquisition or kind of tuck-in M&A side?
I would say that look, it's very difficult when you write an investment thesis to sort of necessarily assume tremendous inorganic growth through acquisition, because you never quite know how available that growth will be. But it is always, I think, we would always have it as one of our cases, unless it was a business that entirely didn't lend itself to organic growth through acquisition. But our base case is usually organic growth. And that's the one we're really fighting for. If we can expand the pie, or we can back that up through other forms, other styles of growth, we'll take it.
Absolutely. Thank you. Harry, I'll turn to you. Also on organic levers,
Yes.
I think in this, kind of day and age, it seems, you alluded to some macro tailwinds behind Japan. How are you marrying that with driving value creation?
Yes. First of all, I like to emphasize that, when we talk about Japanese mid-market traditional industrial business, people tend to think that it's very cheap, right? So yes, it's cheap. Our entry multiple average is like 6 times of EBITDA. But we are not value investor per se. I don't think we can expect much multiple expansion anyway. So our return mostly coming from EBITDA growth and debt repayment. So we need to improve profit and loss as well as cash flow of the target company. We cannot rely on multiple expansion unless you have a very strong reason why you can do that. So how we improve profit and loss and cash flow of our portfolio companies? Well, inflationary economy is a very, very important thing, because under deflationary economy, what you can do is to cut cost and sell assets, right? To match up your continuing a squeeze of your gross margin. Under inflationary economy, completely different. your cost is up, so you cannot cut costs. Okay, so you have to go into the customer's office to increase the price. So price increase is number one. Number two, you have to manage working capital because people tend to own too much inventories under deflationary economy. Deflationary economy means interest rate is almost zero. So working capital is not a cost for you. So our mid-market portfolio companies tend to have so much inventory. So we need to manage the inventory. That's number two. Number three, under deflationary economy, people are used to save cash, keep, piling cash on the balance sheet. Japanese manufacturing business is so much infamous of having so much too much cash. But under inflationary economy, you have to spend cash. So we work with our portfolio company how to do a capital expenditure, investing into ITs and also buying other companies. So add-on opportunities kicks in there. Now, lastly, under inflation economy, you have to hire right talents because we are, in the decreasing populational economy, and we are under inflation economy. That means that people's costs are getting higher. So how to secure right talent for our portfolio company, pretty important. So these are four key driving factors in value creation initiatives, particularly adjusting to inflation economy. And that's pretty important in traditional manufacturing businesses in mid-market in Japan.
Super interesting. Japan shifted into an inflationary economy. There was a time when, deleveraging and our debt pay down was maybe one of the, tools to driving value in Japanese private equity. But that's all changed.
By the way, talking about inflation, okay, we are talking about only 4 to 5% CPI, not like 8, 9% CPI. So we are still talking about very modest inflation, which is good for the economy. Yeah.
Right. Very clear. Alex, your views. Would love to get your views on value creation and how you're seeing that in your portfolio.
Yeah, I guess maybe I'll talk about Korea and India as well on this topic. I think in both of these countries, it's about helping companies to achieve economies of scale and to improve their profitability. And I think that means strengthening governance, professionalizing their management teams. We see a lot of companies also investing in technology and then building the infrastructure that they need to support rapid growth. And we're seeing that across different industries. So, from healthcare to financial services to, consumer sectors. Just thinking of one of our portfolio companies in the healthcare space. So actually, we have a number of these. So, for example, hospital chains. These hospitals are growing by both greenfield and brownfield growth, acquiring smaller clinics and then standardizing the operations across the hospital chain, and also centralizing functions like procurement so that it can buy, the medical supplies at a better rate, and then investing in IT and finance also to capture the economies of scale. So actually, I guess similar to, what my fellow panelists have spoken about. Yeah.
Thanks, Alex. And I think we've got a lot of insight from this discussion on value creation. Moving to the kind of last part of the value journey is on the exit. And want to collect your views on regional exit environment. And so, Harry, I think Japan is top of mind and seemingly in a fortunate position with a few exit routes still open and possibly expanding. How are you seeing viability of exits?
Yes, so we are pretty lucky because we have so much liquidity still in the market. Japanese banks are willing to lend money. So, and we have a interest rate coming up, but still a very reasonable level of interest rate. For example, LBO loan today's all-in cost is like 3 to 4% on this, and we are joking that Japanese banks making LBO loans less than U.S. Treasury interest rates. So we have still a bunch of liquidity in the market. And also, because of inflation economy, strategic buyers are becoming pretty active. So they are making decent offers to strategic opportunities. And as a result, we see almost no problem in exit market. If you're, investee private equity firms, Japanese talking about exit difficulty, they are lying. Okay, we have a bunch of exit alternatives in the market. And we are about to exit from our first transaction, which is salt manufacturing business, salt for as a material for processing food. It's a very traditional manufacturing business. Yet you can make 3 times in 3 years, and we've got decent offers from strategic buyers. So that tells you how strategic buyers are becoming active in under inflation economy, and that related to my statement that everybody start to spend money. Okay, under inflation economy, you have to spend money. So that's comes to activity of strategic buyers. So we are in lucky position.
Yifei, I wanted to, on the exit question, a kind of a subset of the question, which is there's a lot of popularity around secondary CVs. And while GL's, you've paved the way with IPOs and strategic sales, but at the same time, you've executed a very successful continuation vehicle last year that happened to be China's largest single asset CV. And coincidentally, was executed by a capable advisory team. Take us through your thinking on considering that as an interim liquidity option.
Well, Charles, first of all, thank you for Reed and your team to helping us with that continuation vehicle transaction. So our thinking on that is really kind of all the fundamentals laying before us before making that decision is the kind of asset in the vehicle or single asset in the vehicle is a business called Cyclone Pharmaceuticals. Itself is a growing cash flow generative and attractive business. So, we can see kind of it will generate more value in the next owner's hands, whether it's IPO, it's CV, whatever that is. A solid and strong fundamental of the asset itself is the foundation of everything. And then it comes to the practicalities, right? So in the fund where we hold a significant portion of that asset is coming to a natural end. It's not a very good IPO market when we were considering that option. So we are left between kind of, thinking of having to realize at a certain time point or having a structure to allow further value creation of that business in our ownership. And that Cyclone Pharmaceuticals is a majority owned by GL. So we actually have the flexibility and almost the luxury of actually choosing a right path for the business. And the third point is really having to balance the kind of the interest of the selling LPs and the buying LPs, right? So balancing the interest of the existing fund and the prospective LPs coming into this transaction, and we have to price the asset at an attractive value. Yet, to balancing the IR and DPI of what we are underwriting now. So, we have considered quite a few options and really lucky in the end to get one of the largest Middle Eastern sovereign wealth fund to come in as a LP for this transaction. So we're quite happy that we have a very stable and kind of ownership structure for the business in the medium term, where it allow us as a controlling shareholder to continue to generate the value for that business.
Yeah, Yifei, appreciate that. And I'll immediately turn to Alex because Alex, you see it from both sides, from both the investor side as well as operating your own portfolio. What are the strategies you're seeing? And then importantly, on the same topic of CVs as interim liquidity.
Yes,
Love your thoughts.
definitely interesting topic. We see an increase in the number of these CV transactions, which are clearly helpful to generate exits, give cash back to investors, and also create investment opportunities, right, for new investors. I think to date we have been, much more of an investor, so much more on the buy side rather than the sell side in the CV. And I think, I agree with a lot of things that Ife mentioned earlier. It's a very useful tool when you use it appropriately. And it makes sense when you have a high quality asset, value creation is still ongoing. And then your existing fund is at the end of its fund life, right? I think selectivity and alignment are both very important. So, I wouldn't suggest using a CV when you have a weak asset, that's stalled in its value creation. A CV really works best when there's very clear visibility on the next phase of growth. This is a very strong growing asset, and investors can still generate returns from it. And also, there's going to be a credible exit, in just possibly a few years down the road, right? And you're not going to have to rely on maybe yet another CV to exit. Right. And I think very importantly also, I think Ife also mentioned this, pricing needs to be fair for both the selling, rolling LPs or incoming LP. And then the incentives of the GP and the investors need to be properly aligned as well. Yeah, but certainly a growing part of our market today. Yeah.
Thanks, Alex. Yeah, no, it's clear that executing a successful CV today does show a lot of strength in that both the asset and the manager. A lot of confidence is required to execute with investor support. Justin, lastly, turning to you, you've been a master of having executed a whopping 25 exits in your PE journey. So yeah, what are you seeing? What insights are you seeing in kind of driving either strategic trade sales or other exit types?
Charles, yeah, I think, look, in that journey, the exit market goes through cycles. So I think over the years, when the public markets opened or the sort of Chinese buyer set opened or different opportunities came, one of the trick was to take that opportunity when it was there, because if you missed it later, you would regret it when it went away. I think where I've sort of got to in the evolution of that cycle is when we invest, we're very, very focused from the outset on how we're going to sell the asset and who are the buyers for that asset. And very much from the start, we're shaping the relationships with that buyer set. We're talking to them, we're talking to advisors, we're building our position, and we're making decisions in the investment itself, knowing that those decisions, for instance, would be attractive to particular buyers. I think, but the sort of general answer to that question is one of the things that is hard to do is sell larger assets, and the larger assets are more cyclical in terms of that exit market. So by investing in smaller assets, even though the scale is a little smaller, you then open yourself up to, by the time you've grown the asset, if you can make sure that the size of the asset is not so big that it's not a huge bite for trade buyers, and you've probably got the option of the secondary markets as well, the institution and the private equity markets, knowing that the public markets, really only open in our country anyway for short periods of time and then disappear. So it's and I think one of the tricks over the years is it's easy to buy a larger orphan style asset. It's very hard to get rid of it. You may be able to get it into a continuation vehicle if it's intrinsically a fabulous asset, but often private equity has been caught in the trap of picking up assets that no one else really wants. And now, unfortunately, that comes back to bite at the end because no one else really still wants them. So I think it is a trick. DPI is just so important right now. So I think right now, if you're making investments, you've got to be immensely focused on how you're going to get an exit in this time. DPI seems to be the lifeblood of the private equity industry right now.
Thank you, Justin. That is hugely insightful. Mastering the cycles and really, taking the opportunity upon reaching your return hurdles, of course. but those are great. That's great advice. Um, so, panelists, that wraps up our discussion for today. I want to thank you. We've had a great 45-minute discussion. I'll just let the audience type any questions that they might have into the remaining 5 minutes that we may have here. Yeah, so please type in your questions. So actually, we do have first question here is when it comes to India, the ecosystem, as mentioned by Alex Lee, has certainly improved, though there are not many exits, and this despite the fact that the stock market has been on the rise for many years. Do you see we're going to see a clear change in this? Alex, that's a question for you.
Yeah, I think it's certainly true that the public markets have deepened. I think we've seen quite a lot of activity, in the past year, and certainly we have quite a few portfolio companies that are preparing for an IPO. So we are, cautiously optimistic that there will be more IPOs this year. And there's a lot of domestic investor participation as well. A lot of people in India are very excited, buying stocks, participating in the stock market. And I think we also see increasing exits via trade sale as well as fund-to-fund activity. So it does seem that the exit environment overall is improving in India. Yeah.
Thanks, Alex. It's an open question for all our panelists. Have you observed significant differences across Asian countries in how trust is built between foreign private equity funds and a local company? And how do you adapt your approach with cultural norms and codes that may differ from your own? An interesting question. I'll open up for discussion.
Well, I pick up the question for Japanese market, and we see that mega funds like KKR, Blackstone, Apollo, all these people are doing a very good job penetrating into Japanese market, particularly large cap transactions. And large cap Japanese companies very much used to deal with these people, so there's no problem. There's no culture gap whatsoever. But if you go down to a lower level of companies like mid-market, things are pretty different. People are more naive and more traditional, and they don't even talk to domestic private equity funds. So we have a huge difference between culture between large cap and mid cap and small cap. So we leverage that factor, and we don't compete with mega private equity firms in middle market, lower middle market. So
exciting, hunting grounds. Yeah. Yeah. Anybody else? Your thoughts, Jifei, Justin, Alex?
The only thing I'd say is that I think it's extremely hard, and in my career, at times when I've even through a portfolio company sought to make an acquisition in another country, it's fraught with peril because it's not the country you know. So for me, I've been hanging around this, working in this environment for 30 years. I've got people here that I know and trust. I've got advisors and partners that I've worked with for 20 or 30 years. And so there's a lot that can go wrong when you're investing, and by having the right people around you, you at least reduce that chance. I think it's very much harder if you fly in, fly out, or from other countries. Not impossible, but a lot harder. And I think to Harry's point, that is exacerbated more so in the mid market, because obviously if the bigger you are in the town, then sure, it probably becomes a more international approach and language. But we're looking, where it's less contested. It's cultural norms are very important, and having the right team around you and the right knowledge to reduce information asymmetry as much as you can.
I would certainly echo Harry and Justin's point, with one addition. China is very local for local market, even at larger scale transactions. So if you look at all the global players or global people players who have been successful almost everywhere globally. Hardly you get any players that's very successful in the Chinese market. That's culture, that's regulations, that's local team, that's cultural norm. So there's many factors contributing to that. So, it's very from what we see, what we compete with, we rarely compete with global PEs in the deals we see. Our biggest competitors is actually local strategics who understand the market equally well. That's our single kind of biggest set of competitors for us.
I think it's very, very true. I agree with Justin, Ife, and Harry. In fact, on the primary fund investing side, that's what we do. We are backing GPs in the local markets. So we have a very, very kind of country focus or sub-regional approach, right? Japanese GPs for Japanese portfolio companies or Japanese buyout strategies. So I think in terms of our opportunity fund, we are taking a pan-Asian approach, but we are not doing buyouts there. We're just buying minority stakes in companies. And I think we're always working with one of our GPs, right? One of our GPs is there. The local expert is on the ground and working with the company. And we're buying a minority stake from one of the shareholders that needs liquidity. And what we find here is that very often the GP and also the portfolio company, the CEO, they're very keen to have Axiom on board because we offer an international perspective. And a lot of times we can also link them up with maybe a similar company in another geography, and they can exchange notes. And they really appreciate having our perspectives as well. Yeah.
Gentlemen, thank you so much. I think that was a very, very great question. So thank you for the audience for asking that. But I think there's a resounding agreement across of the board. Trust is the special ingredient in being successful, investing in Asia and across all of our countries, all of our segments. So I think that's a real high note, across all the different insights that we've gleaned today. Thank you all, but it's a really nice way to end that trust, particularly in our region, is critical to forming a successful franchise in private equity. So thank you to my panelists. We'll conclude our RedeConnect Asia section today. Thank you for everyone for joining, and there's a few other questions that we'll send out and aim to answer every one of your questions with the panelists. But we'll conclude here. Thank you so much, and thank you for being with us.
Thank you.
Thank
Thanks
you.
very much.
Great to be here.
Thank you. Thank you all.
Thank you. Bye now.